You negotiate a salary, you sign a contract, and then your first payday arrives. When you open your payslip, the amount actually deposited into your bank account is lower than the top-line figure you agreed to. The UK tax system functions like a ladder, but it begins with a specific threshold that remains out of reach for the tax collector. This is the standard personal allowance. For the current tax years, it ensures that the first £12,570 you earn is entirely tax-free. This foundation isn't permanent. If your income crosses a specific line, the system begins to withdraw this allowance, creating a mathematical threshold where your tax bill increases much faster than the standard brackets indicate. Understanding how this £12,000 figure behaves is the primary factor in calculating your actual take-home pay. To see how this works, we can look at a standard salary of £36,000. You do not pay tax on this entire sum. First, we subtract your personal allowance, isolating the bottom £12,570 as a 0% zone. The government then applies the 20% basic rate of tax exclusively to the remaining £23,430. This tax-free foundation supports the brackets above it. If your earnings push past £50,270, you enter the higher rate tier, where income is taxed at 40%. For income crossing the £125,140 mark, a final additional rate of 45% is applied to the very top. While Scotland uses different percentage rates and band thresholds, the £12,570 tax-free foundation remains the same across the entire UK. You shouldn't view your salary as one massive taxable lump sum. It is a series of distinct blocks, all resting on the structural support of your personal allowance. That base layer can be moved under specific conditions. Through the marriage allowance, if one spouse earns less than the threshold, they can transfer £1,260 of their unused allowance to a higher-earning partner. But the system also takes away. The rules for your tax-free foundation change the moment your income hits £100,000. This is the tapering rule. Once your adjusted net income crosses that line, you lose £1 of your personal allowance for every 2 extra pounds you earn. In this zone, for every £100 of additional income, you pay £40 in direct tax. But because the shrinking allowance exposes an extra £50 of income that was previously tax-free, you pay tax on that too. The result is an effective marginal rate of 60%. By the time your income reaches £125,000, £140, your entire personal allowance has been removed. Within this £25,000 window, a pay raise results in significantly less actual take-home pay than a raise earned at lower brackets. Currently, the £12,570 personal allowance is frozen at this exact number until at least April 2028. Because this foundation isn't rising with inflation, natural wage growth will push hundreds of thousands of people over that £100,000 threshold over the next few years. To counter this, you have to look at how the government measures your earnings. HMRC calculates this tapering based on a figure called your adjusted net income, a number you can change. Making voluntary contributions into your pension lowers your adjusted net income in the eyes of the tax authorities. If your salary is £110,000 and you contribute enough to your pension to drop your adjusted net income back below the 6-figure line, the math reverses. This restores your personal allowance. Dropping your net income below this line also preserves other linked government benefits, like the 30 hours of free childcare, which also end at £100,000. The £12,570 personal allowance is the starting variable for every UK taxpayer. Understanding its behavior is the difference between simply earning more and actually taking more home.